Welcome back to Calm Investors. I am Ruth.
And I am Patrick, and today we are talking about something that I think most people, including me, have been thinking about completely wrong.
Today we are talking about risk, and I promise you by the end of this episode, your definition of risk will be completely different from what it is right now.
All right, so here is what got me thinking about this. I have a coworker, good guy, smart guy, and he keeps all of his retirement savings in a savings account, all of it. And when I asked him why, he said, "I do not want to take any risk." He thinks he is being safe. But after our Season 0 episode on inflation, I started wondering, is he actually taking a huge risk without knowing it?
That is one of the best questions you have asked all season, and the answer is yes. Your coworker is taking an enormous risk. He just cannot see it because it is invisible.
An invisible risk. What do you mean?
So let me start by redefining risk. Because most people, your coworker included, think risk means the market might go down. They see the stock market drop 10%, and they say, that is risky. And they see their savings account balance stay the same every day, and they say, that is safe. But that definition is wrong. Risk is not the market going up and down. That is volatility. Volatility is temporary. It is noise. Real risk, the kind that actually hurts you, is the permanent loss of purchasing power.
Permanent loss of purchasing power. So not losing money on paper, but actually losing the ability to buy things with your money over time.
Exactly. And this is where your coworker's strategy falls apart, because inflation erodes your purchasing power at roughly 3% per year on average. That means if your coworker has $100,000 in a savings account, earning 1% interest, he is losing about 2% of his purchasing power every single year. Not on paper in reality. The number in his account looks the same. But what that money can buy shrinks every year in 20 years. His $100,000 will have the purchasing power of roughly $60,000 in today's money.
So he thinks he is avoiding risk, but he is actually guaranteeing a loss, just a slow, invisible one.
That is exactly right. He is guaranteeing a loss. The market might go down temporarily, inflation will go up permanently, and that is the distinction most people miss. Volatility is the price you pay for growth. Inflation is the price you pay for safety, and over 30 years, inflation is far more expensive.
Okay, so if risk is not volatility, and the real risk is losing purchasing power, then how should I actually think about risk when I am making investment decisions?
Great question, and this is where it gets really interesting, because there are actually 3 types of risk that every investor needs to understand, and they often conflict with each other.
3 types. Okay, let us hear them.
Number 1. Risk tolerance. This is the emotional one. How much volatility can you stomach? If your portfolio drops 30%, can you sleep at night? Can you resist the urge to sell? We have spent this entire season learning about the biases that make this hard: loss aversion, panic, herd mentality. Your risk tolerance is how much of that emotional pain you can handle without making a bad decision.
Okay, so risk tolerance is basically how much I can handle emotionally before I do something stupid.
That is a very honest way to put it, and it is accurate. Number 2. Risk capacity. This is the financial one. How much can you actually afford to lose? If your portfolio drops 30%, does that change your life? Can you still pay your bills? Can you still retire on time? Risk capacity is about your financial situation, your income, your expenses, your emergency fund, your timeline. Someone with a stable job, low expenses, and a 20-year timeline has high risk capacity. Someone about to retire with no other income has low risk capacity.
Okay, so tolerance is emotional, capacity is financial. What is the third one?
Number 3. Risk need. This is the mathematical one. How much return do you actually need to reach your goals? If you need your money to grow at 7% per year to retire at 65, Then you need a certain level of risk in your portfolio to achieve that. You cannot get 7% returns from a savings account. The math requires stocks. Your risk need is the minimum amount of risk you must take to reach your goals on time.
So tolerance is emotional, capacity is financial, need is mathematical, and you said they often conflict.
They conflict all the time, and this is the tension that trips up most investors. Here is a common example. A 25-year-old with a stable job and 30 years until retirement, their risk capacity is high. They can afford to lose money because they have decades to recover. Their risk need is high. They need strong returns to build enough wealth for retirement, but their risk tolerance might be low. They watched the market drop and they felt sick. They wanted to sell everything, so their emotions say be safe. But their finances and their math say take more risk. That conflict is real, and it is what this entire season has been preparing you to manage.
So I might be emotionally scared of stocks, but mathematically need them. That is exactly where I am, Ruth. I know I need to invest, but the idea of watching my money drop still terrifies me.
And that is completely normal. The goal is not to eliminate the fear. The goal is to build systems that keep you invested despite the fear. That is what your investment policy statement is for. That is what the 72-hour rule is for. That is what automation is for. You do not need to be fearless. You need to be prepared.
Okay, so I have my 3 types of risk. But you mentioned something earlier. Time. How does time change the picture?
Time is the single most powerful risk reducer in investing, and this is not opinion. This is data. A 30% market drop is devastating if you need the money next month, but if you need the money in 20 years, that same 30% drop is a footnote. It is a blip on a chart that trends upward over decades. The S&P 500 has never had a negative return over any rolling 20-year period in its history. Not once, short-term. The market is a casino long-term. It is a wealth-building machine. Time transforms risk.
Never a negative 20-year period. That is a powerful statistic. So the longer my timeline, the less risky stocks actually are.
Exactly. And this is why age matters so much in investing. A 25-year-old with 40 years until retirement can afford to be almost entirely in stocks. The volatility does not matter, because they have decades for it to smooth out. But a 60-year-old who needs the money in 5 years? They need more stability, more bonds, less exposure to short-term drops, because they do not have time to wait for a recovery.
That makes sense. But what about the order of the returns? Like, does it matter if the bad years come early or late?
Great question. This is called sequence of returns risk, and it matters most near. Retirement here is the idea. Imagine 2 investors who both average 7% returns over 30 years. Same average, but one gets the bad years early. Big drops in the first 5 years, then recovery. The other gets the bad years late. Strong growth first, then big drops near the end. Even though the average return is identical, the outcomes are dramatically different. The investor who got bad returns early, while they were still adding money, actually benefits, because they bought more shares at lower prices. But the investor who got bad returns late, when they were withdrawing money, gets devastated, because they are selling shares at low prices to fund their retirement.
So the same average return can produce completely different outcomes depending on the order. That is kind of scary.
It is, and it is why your asset allocation should change as you get closer to retirement. When you are young and adding money, volatility is your friend. Drops mean cheaper shares when you are older and withdrawing money. Volatility is your enemy. Drops mean selling at a loss. This is the practical reason why people shift from stocks to bonds as they age. Not because stocks become riskier, but because the sequence of returns becomes more dangerous.
Okay, so let me bring this back to my coworker, the guy who keeps everything in a savings account. He thinks he is being safe, but what you are telling me is that he is actually taking the biggest risk of all.
He is because the risk of being too conservative is just as real as the risk of being too aggressive. A 25-year-old who puts everything in bonds or a savings account will almost certainly not reach their retirement goals. The math does not work. They need the growth that stocks provide, and by avoiding the visible risk, volatility, they are guaranteeing the invisible risk, running out of money. Being safe can be the riskiest choice of all.
Being safe can be the riskiest choice that is going to stick with me.
Good. Because that is the mindset shift this episode is about. Risk is not what most people think it is. It is not the market going down. It is not seeing red numbers on a screen. Real risk is the permanent loss of your ability to reach your goals, and sometimes, the path that feels safest is the one that guarantees you never get there.
All right, so what is the practice for this week?
For each of your financial goals from Season 0, I want you to write down 3 things. Number 1, your risk tolerance. How would you feel if this money dropped 30%? Be honest. Number 2, your risk capacity. Could you financially survive that drop without changing your life? And number 3, your risk need. What return do you need to reach this goal on time? If your tolerance and your need conflict, if your emotions say be safe but your math says take more risk, that is the tension you need to resolve before you start investing, and that is exactly what the rest of this season will help you do.
3 questions for each goal: tolerance, capacity, need. I am doing this tonight.
Good. Let us lock in the key takeaways. Number 1. Risk is not the market going up and down. That is volatility. Real risk is the permanent loss of your purchasing power, whether through bad investments or through inflation eating your cash. Number 2. There are 3 types of risk that matter: tolerance, which is emotional; capacity, which is financial; and need, which is mathematical. They often conflict, and understanding that conflict is essential. Number 3. Time is the single most powerful risk reducer. A 30% drop is catastrophic in 1 year, but a footnote over 30 years. Your timeline changes everything. And number 4. Being too safe with your long-term money is itself a risk. Guaranteed low returns may guarantee you never reach your goals.
And your homework for each of your financial goals: write down your risk tolerance, your risk capacity, and your risk need. If they conflict, that is the tension you need to resolve, and we are going to help you do exactly that.
If this episode changed how you think about risk, follow Calm Investors wherever you are listening. Share this with someone who thinks keeping everything in cash is safe.
Thanks for listening, everyone.
Stay calm, build wealth,